Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio, cutting right through all that market weakness. Now today, we're putting a really hot stock under the microscope, Lincoln Educational Services, ticker LINC. Look, this company is in a booming sector, and it just posted a set of numbers that frankly blew the doors off expectations. On the surface, yeah, it looks like an absolute fortress. But you know our job here. We're here to stress test that foundation.
I mean, you heard it right there, straight from the CEO, Scott Shaw. He's basically laying out a blueprint for total dominance, right? You've got massive demand, what he calls flawless execution on expansion, and a core business that's rock solid. It's exactly the kind of statement that makes Wall Street sit up and take notice. It paints this picture of a company just firing on all cylinders, building this incredible growth story brick by brick. You look at that, and the bull case, well, it almost seems too easy, doesn't it?
Whoa, hold on a second. Confidence is one thing, I get it. But let's be real, the market is an absolute graveyard of so-called flawless growth stories that shattered the second they came under a little pressure. I mean, anybody can make numbers look good for a quarter or, even a whole year. We're here to drill down past that shiny surface. Is this foundation built on solid bedrock, or is it just a pretty facade sitting on some really shaky ground? That's the real question we need to answer. So yeah, let's start the stress test.
Okay, fair enough. But before we dive into LINC's specific numbers, we absolutely have to understand the ground they're building on. You can't analyze the building without checking the foundation, right? And this isn't just about one company. It's about a massive structural shift happening in the American economy. What we're talking about here is the skills gap. It's a real thing. There is a chronic, severe shortage of trained technicians in this country. And that, my friends, creates a powerful tailwind for any company that's positioned to fill that void.
And what's so fascinating here is how all these different forces are converging into what is essentially a perfect storm for a company like this. I mean, look at it. You've got employers who are just desperate for talent. You've got students and their parents finally waking up and realizing that a 4-year college degree isn't the only path to a 6-figure salary anymore, especially with all this talk about AI threatening to automate a ton of white-collar jobs. I mean, let's face it. You can't automate a plumber, right? You can't automate an auto technician. You add in government policy that's now actively pushing for vocational training, and suddenly, LINC isn't just sailing with favorable winds. No, they're sailing with a Category 5 hurricane at their back.
All right, now let's get to the real steel beams of this story, the 2025 results. This is where the rubber meets the road. This is where we see if the company is actually capitalizing on those huge macro tailwinds we just talked about. We're going to examine this whole structure, piece by piece, starting with the top line and working our way all the way down to the foundation, its cash flow. This right here is the bull case in its purest, most powerful form. Okay, let's start with the big headline number. Over $500 million in revenue for the full year. We're talking $518 million. This is not some small-time operation, folks. This is a significant, major player that is building a very serious business. That figure alone tells you they have scale, they have reach, and they are carving out a major piece of this market. It's the kind of number that just grabs your attention. And here's the thing. We're not just looking at a big, static number. We are looking at absolutely explosive growth. I mean, look at this. They went from $440 million to nearly $520 million in just 12 months. That's a jump of almost 18%. In this economy, that is some serious heavy-duty horsepower. This isn't just some small, incremental progress. This is the company making a powerful statement that its strategy isn't just working, it's accelerating. Okay, revenue is great, but revenue is one thing. Profit is what really matters, right? I mean, plenty of companies can go out and just buy revenue at a loss. So what about the bottom line? Show me the profit.
And that is the absolutely crucial point. I'm glad you brought it up because net income, it doubled. We're talking 102% increase. This isn't just growth anymore. This is powerful, textbook operating leverage. What that means is, as they scale up, each new dollar of revenue is costing them less and less to generate. So a bigger and bigger chunk of that money is dropping straight to the bottom line. They are building a highly efficient, profit-generating machine.
And this, right here, is the engine that's driving this entire machine. Nearly 21,000 new students. That's a 15.2% increase from the year before. This is the raw material for their entire business. It's simple math. More students mean more revenue, which, as we just saw, is translating directly into explosive profit growth. And get this, This was their 13th consecutive quarter of growth in student starts. This isn't a fluke. It's not a one-off. It's a durable, established, powerful trend. So, okay, let's just put it all together on one screen. Take a look at this table. Every single key metric is an absolute blockbuster. Revenue, up nearly 18%. Net income, up a staggering 102%. Adjusted EBITDA, and that's a really key measure of core profitability, it's up almost 60%. And then look at the foundation. Operating cash flow, the actual real cash the business generates, it more than doubled. I mean, this is a picture of a company that is just hitting its stride, building a financial fortress on every single front. It's really hard to argue with these results.
Yeah, it is hard to argue with past results, you're right. But you know what? The market doesn't pay you for the past. It pays you for the future. And that is where the story starts to get a lot more complicated. Those numbers are the rear view mirror. But when you start looking through the windshield at the 2026 guidance, you start to see some potential weaknesses, maybe some hairline cracks forming in that armor. So I think it's time we apply a little bit of pressure and see what happens.
Look, I'll admit it, the bull case is compelling. It's a shiny, well-constructed story, but our job here at Iron Financial is to ask the tough questions. You know, like why, with all this incredible momentum, did the stock actually pull back after this supposedly amazing report? What is the market seeing that isn't so obvious from those big headline numbers? Let's start digging, and let's start with the most glaring issue of all, the guidance they gave for the year ahead. And here it is. This is the big one. For all the talk of blockbuster growth, their earnings per share guidance, that's the profit per share for 2026, came in way below what Wall Street was expecting. You had analysts modeling around 81 cents per share. The company guided to a midpoint of just 69 cents. I mean, that is a huge miss. That's a big red flag that just forces you to stop and ask, if everything is going so unbelievably well, why is future profitability suddenly looking so much weaker than everyone anticipated? Okay, that's a fair point, but you're missing the critical context here. They changed how they calculate their main profitability metric, adjusted EBITDA. You know, that's earnings before interest, taxes, depreciation, and amortization. It's supposed to show the pure profit from operations. So, starting in 2026, they're now including about $10 million in costs from opening up new campuses, costs they used to just exclude. Management says they're doing this for transparency, it makes the numbers more honest, and it accounts for a big part of that guidance gap you're talking about.
Or it's just a convenient way to obscure the fact that the cost of their growth is going way up, and maybe their core profitability is slowing down. You know, transparency is a fantastic buzzword, but is this new math just hiding the incredibly heavy lifting that's now required to keep this growth engine running? Because $10 million, that is not a small number to just brush aside.
And you know what? Speaking of heavy lifting, look at this number. Depreciation expense. It is set to absolutely skyrocket to $33 million in 2026. Now that's up from just under $21 million in 2025. What does that tell you? It tells you that all this expansion, all the new buildings, all the shiny new equipment, it comes at a massive cost. That heavy capital spending isn't some abstract investment for the future anymore. It's showing up right here, right now, as a very real, very significant drag on net income. This is a crack in the foundation that you just cannot ignore. All right, let's pivot for a second. Let's move from the financials to the actual operations. Because for a school, student outcomes are literally everything. And this, to me, is a big yellow flag. The graduation rate actually dropped by 200 basis points. It's down to 67.5%. So yeah, they're getting way more students in the front door, no question about it, but are they getting them out the back door with a diploma? Because if you're growing your enrollment, but the quality of your outcome is slipping, then all you're really doing is building a bigger, leakier bucket. Okay, I see that point, but I'm going to counter you immediately with this. Look at the placement rate. That's the percentage of graduates who actually get a job in their field. That number is up 250 basis points to nearly 83%. Now, for a vocational school like this, isn't that the single most important metric? I mean, students don't go to LINC just to get a piece of paper. They go to get a career. And on that front, the company isn't just succeeding, it's actually getting better. This shows that the students who do graduate are highly, highly in demand. So, here's where we are. We've got the bull case, which is built on a rock-solid 2025. And we've got the bear case, which is poking holes in the 2026 outlook. So now, let's look at the company's actual blueprint. How exactly do they plan to navigate these headwinds, the higher costs, the accounting changes, and still continue to build the structure higher? This is their strategic roadmap for growth. Okay, let's look at the full guidance table for a moment. Yeah, despite that EPS miss that clearly spooked the market, the top-line story is still incredibly strong. They're guiding for another 13% revenue growth at the midpoint. Student starts are still projected to grow at a double-digit pace, and check this out.
Adjusted EBITDA, even at that new, more conservative calculation we talked about, is still expected to grow by 30%. That tells me the underlying strength of the operating model is still very much intact.
So where is all that growth going to come from? Well, it's not just wishful thinking. They have a very clear three-pronged construction plan. First, they are breaking ground on brand new campuses in New York and Texas. Second, they're not just building new stuff, they're expanding their most successful high-performing existing locations. Smart. And third, they're building deeper and deeper pipelines through corporate partnerships and high school programs, which ensures a steady flow of new students into the system. This is a clear, actionable, multifaceted strategy. Okay, now this next number, this is maybe the single most important number for the long-term bull case. Are you ready? Right now, their existing infrastructure is only at about 60% capacity. Just let that sink in for a second. They have 40% of their physical space, their classrooms, their workshops, just sitting there, available to be filled with more students. This is a massive, massive lever for future profitability. Every single additional student they bring into that existing infrastructure comes at a much, much lower marginal cost. That means margins can expand significantly as they just fill up the campuses they already have. The really heavy lifting of the initial build-out, it's already done.
All right, we've covered a lot of ground. We've seen the shining fortress of their 2025 results, we've pressure tested the foundation, and we definitely found some potential cracks in the 2026 guidance. We've reviewed their blueprint for future expansion, so now it's time to put it all together. It's time for the final verdict. We need to weigh all this evidence and decide, is LINC a solid investment opportunity, or is it a value trap just waiting to spring? Okay, let's lay it all out side by side. The bull case is compelling. It's built on a solid foundation. You've got undeniable student demand in a booming sector. You've got a proven ability to translate revenue directly into profit, a crystal clear roadmap for expansion, and on top of all that, a pristine balance sheet with zero debt. That is a powerful, powerful combination. But the bear case raises some very serious questions. That EPS guidance miss is a major overhang, and it raises real concerns about future profitability. The massive increase in capital spending and depreciation, that is going to be a drag on earnings, no question. That declining graduation rate is a yellow flag on their operational quality. And let's not forget execution risk. I mean, juggling this many new campus projects at once is an incredibly difficult feat to pull off. So it all comes down to this. Here is the final question for your portfolio. This company has undeniably built a strong structure so far, and the market has rewarded them for it. The bull case says the macro tailwinds and that incredible operating leverage mean they are just getting started, that they're building a true skyscraper here.
But the bear case is a warning. It warns that the higher you build, the more stress you put on that foundation. And the guidance seems to suggest that the next few floors are going to be a lot more expensive and a lot less profitable to build than the last ones were. So the ultimate question you have to ask yourself is this: are those cracks we identified just minor cosmetic issues, or are they signs of a much deeper structural problem? That's the analysis you have to make for yourself. Thanks for joining us here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.